Well, the market is steady, so let's get going and welcome our management on the show. Ravi Vishwanath, the CFO at Quest Corp, is joining us. Ravi, hi, good afternoon. Thank you so much for speaking with us. First up, wanted to discuss the Monster business itself. Had a two-part question there. A, with respect to the cash burn that you're doing on marketing, what's the run rate right now? And secondly, by when do you expect it to break even and deliver those results and the revenue growth that you had been talking about?
Okay. So let me talk about the Monster break-even. Monster actually, achieved a break-even during Q2, Q3 of last year, and that was what prompted us to go out and believe that there is definitely a greater potential for a product like this in the market, and that's what also was also what the external investors saw before they put in money into Monster. So Monster achieved a break-even Q2, Q3 last year, but definitely needed a lot more capital infusion from a product development, sales and marketing perspective, and that's where we went and raised external capital. So the point is, sales and marketing, we will be spending a fair amount of money between this year and next year. We do think that between Q3 of next year, which is FY24, Q2, Q3 of FY24 is when we will achieve a proper break-even despite these increased costs.
Right. Hi, good afternoon, Ravi. This is Cheryl also joining in the conversation, and let's talk about the IT staffing. When it comes to IT staffing growth, it has actually slightly slowed down a bit. So by when do you actually see a recovery in that particular growth area? And also, can we expect a 15% plus CAGR during FY22-25 estimated as guided at the end of FY22?
See, IT staffing, there's been a change of strategy at our end, which actually began in FY21. Till FY20, we had a fairly large exposure to the ITES sector or the low-end sector, where you had large number of headcount with the margins not being what they should be. So in FY21, we changed the strategy where we said that we will exit some of these low-margin mandates, high-volume, low-margin mandates, and replace them with high-margin, low-volume mandates. And that's what we've done over the last couple of years, and it's paid us, and it's actually helped us in good stead. In the sense that if you look at the IT staffing headcount, our headcount has actually remained flat over the last 2 years, but our margins tremendously has actually increased substantially over the last 2 years. So we do think that this is a conscious effort at our end, saying that the volume growth for us would come in from the general staffing business, and the value or the profitability increase will come in from the adjacencies like IT staffing, overseas and stuff like that. So we strongly believe a 15% growth rate in IT staffing is absolutely doable, given where we are currently, and we have no reason to believe that we would not be able to get to those numbers in the 22-25 time frame at all, actually. So we will be able to get to a 15% CAGR during this time frame, and there's no reason, no cause for concern as far as IT staffing is concerned. IT is actually on an upswing. We did have challenges in hiring people over the last couple of years. We were not able to hire talent on time, given that everybody was walking around with at least 2 or 3 offer letters in their pocket. But that is actually changing. And that's a good sign for us. And I think we will be able to get back to the 15% upwards of growth rate from now onwards for the next 2-3 years. I think we should be easily be able to get to those numbers.
Sure. So 15% is definitely possible. Ravi, also wanted your quick take regarding the capital allocation policy. You've been quite, conscious around that and quite a bit conservative. But are things changing, and are you looking at maybe acquiring something?
We came up with a capital allocation. A formal capital allocation policy was announced last year in May, where we said 1/3 of our free cash flows we'll use it to return it back to our shareholders, either in the form of dividends or buyback. 1/3 we said we will use it for our internal growth, and 1/3 we said we will use it for strategic initiatives like acquisitions if there are anything meaningful, etc. Having said that, we have not come across anything meaningful yet on the acquisition front, So we've been using that part of the cash flow for reducing our gross debt. If you know, if you kind of notice, our gross debt has actually come down substantially over the last few years, and it's at a completely manageable kind of levels right now. So given that, we do not so coming back to your question, this is a formal stated capital allocation policy that we have, and even as of now, we don't have anything that's going to consume cash at our end. We don't have any large deal that we are looking at or doing a due diligence or sign a term sheet to acquire, which is going to probably need capital at all at this point of time.
Got a lot from you in terms of how the monster business is shaping up, as well as how the bounce back in IT would play out. We'll let you go on that note. Thank you so much for joining us today and making sense of all of that. But moving on, apart from IT, the space which